What's up, traders? So here comes another question from my social media. It's a very, very commonly asked question. Where and when do we take profits? Now, there's a lot of good answers to this question. And in fact, there's only one wrong answer. And that one wrong answer is to not have a plan. There's some that want to take off 50%, half their position at a target. There's others that want to take off 25%, 75%, 90%. The important thing is to just figure out what's going to work for you. A lot of people that I talk to are trying to come up with the optimum amount to make sure they get the most profit possible. But markets change. If you get into a slower period on the markets or on a particular stock, it may be better to just take off the whole thing at your target or take off the majority. Me personally, I like to take off 75%. And there's some math to it, which I'm going to go into and explain why this works for me. This is just an idea. You don't have to do this, but here's my logic around the reward risk that I like to go for. So we're looking at a chart of Roku. This is going back into November. So I picked a nice, great example that's going to work for this one. Let's see here. So if we were to have gone in long on this right here, I like to go for a 3-to-1 risk reward ratio. So we're going to put our stop just below the low right here. And then let's move this up until we get a 3-to-1. And we'll go ahead and mark that off. So right there is going to be our target. And here is going to be our stop. And that sets up with a 3-to-1 risk reward ratio. So let's do a little bit of annotation here. So if we're going for a 3-to-1 reward, or say reward to risk ratio, that means that we're going to be risking $100 and we are looking to get 300 out. Now this is if we took it all off at the target, the whole position. And so if we go forward and we see if we'll hit our level and our target. Okay, so at this point, we've hit our target. And so we can either take off the full position, the 100% of it, or we can take off 75%. We've taken off 75% at the target. So what we end up with in our pockets is $225 if we had risked enough to have $100 risk on this position, because that's 75% of 300, which was our reward. We still have a position on. Now, how long are we going to let this go on to? Well, we could let it go on forever, but stocks eventually come back down. So I'm going to look for a 12-to-1 from my initial risk. And it's not just an arbitrary number. Let's go through and see what happens here. So if we leave our remaining 25% on, let's put it back up to our original point right here. And we're going to have to zoom a little bit to get this to work. 12 right here. So 12-to-1 is very ambitious, but remember, we've already taken profits. Even if this comes back to our level right here, we are going to still make money. And we'll look at that example in a minute if it comes back on that remaining 25%. So if this keeps on going, we keep on holding it, waiting to see if we'll get 12-to-1. It could take a few days or weeks or even months, but we're patient. We have taken our profits, so we're not in as many shares as we would have been otherwise. So we have plenty of buying power. And so we're able to then capture that full 12-to-1. Okay, so now what would happen if we had the profits from both of them? Well, let's just take a look. So if we bring up our handy dandy calculator and we say that we did a 1,200, which would have been, if we had the full amount on, times 25%, that's 300. And so with the remaining 25%, we're going to get an additional $300. And so what we've done is we've essentially more than doubled our profit if we had just taken off everything at the 100%. And so it sort of works out that way where we end up with twice as much as we would have had otherwise with a 3-to-1 risk reward ratio. And so that's why the math works out to me that I want to do this type of strategy 75% of the initial target of 3 to 1, and then go up to a 12 to 1 or more. That way, we end up doubling how much we would have gotten otherwise. Now, let's say we take off profit. And the main reason we take off profit is because we don't want to give it back. We don't want the whole position to come back against us. And so let's look at a position in Apple that happened fairly recently. So in Apple, let's take a look at this right here. So this was a pullback to a level that I like here. Zoom it in a little bit. Again, these are 30-minute charts. And so let's do a short setup. Make sure that we get our profit going here. So give ourselves a 3 to 1 to there. Okay. And let's let that play out. And we're out. We're out our 75%. So again, we're doing a $100 risk. We were originally shooting for a 3 to 1 reward risk ratio. And now we've pocketed 225, and we at our 75%. And now we have on 25% left. So we let this continue on. We have a remaining 25%. We're still shooting for this to go down to a 12 to 1. May or may not get there. Let's see what happens. Remember that our stop on our remaining 25% is up here. We're waiting. We're patient. We don't care. We don't care that it's coming back. It's coming back to us because we've already taken profits. And you probably already know what happened because tech has had a run up. Eventually we'll get there. Coming up into April, and boom. Okay, so now we are stopped out of our 25% position. So what is our remainder? So remember, we had on 25% of our $100 risk. So it's just very simple. I don't even need a calculator for this, but I'll do it anyway. 25. So if we had on our remaining 25%, then we would lose $25. Not that big a deal, especially since we took off $225. And what that ends up being is a profit of $200 overall, which ends up being a 2 to 1 risk reward ratio, which is great. Basically, if we did it this way, where we let the 25% come back and stop us out after taking off 75%, the math works out so that we still get a 2 to 1 risk reward ratio. That means that we can lose twice and one winner will make it up for us. Add to that any big winner that we have that goes on for anywhere from 5 to 6 reward risk, because we doubled our profits by doing the 75% and then shooting for that 12 to 1. So this is why I like this way of doing things, because we let ourselves, even in a medium case scenario, not worst cases, we take the full loss of $100 or one risk. The middle case is we take off a 2 to 1. We get a 2 to 1 out of a good trade. And the best case scenario, if we let a runner win, we've got something like a 6 or a 7 to 1, which is fantastic. That means you can take 6 losers over the course of the year and you still made money. It's good stuff. So hope this answers the question for what should we do? What is optimal? Again, come up with your own system. This is why I like this system. This is what I do. But figure out what works for you. Some of the considerations you may want to think about are your patience, your emotional temperament. Maybe you just want to be out of the market. Maybe you just want to take everything off at the target and you're done. Find the next opportunity. Or if you find yourself doing that and always looking back and seeing what you could have had, leave a little bit on. Or if you're really aggressive and you want to make some YOLO gains, take off a smaller percent. Either way, if something goes in your favor very, very quickly, respond to it. That reminds me, there was one that I talked about in a video last week. This was RMO. And the person I was speaking to, they bought it around the $8 mark when it came down on earnings here. Well, from that point, the next day that we spoke about that, it was up almost 57%. That's a huge gain to make in a day. You got to respond to that. Granted, this stock, if it does a full recovery, it could come back pretty far. But if you have a big move like this in a day, take some off the table, even if it's a small amount. And this is a key example for why you want to take some off. It could be the only opportunity that you had. So hope these examples give you great food for thought. Trade wisely, and we'll see you in the next video.